My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends? I'm just trying to save you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. The market melted down today because many investors now believe we're in, let's say, about to have an experience that is like the apocalypse, an Omicron apocalypse that can no longer be stopped. Dow plunging 532 points, S&P plummeting 1.03%, Nasdaq dipping 0.07% after being down big at the opening. Meanwhile, others welcome the possibility of an Omicron blow-off that infects everybody, doesn't crush the vaccinated, although we know that's not true for those who lack vaccination. They still get very sick. And because it infects so many, it finally marks the end of the pandemic because there's no one else to get it. All right, the two groups seesawed back and forth all day. But ultimately, the bearish COVID narrative prevailed, and the market went up pretty bad. Now, I wouldn't be surprised if this new COVID variant becomes a lot like the measles. Yeah, where everyone gets it, and we move on. There was one kid in your class who had it. Everybody had the measles by the end of the day. Those of us old enough to remember the measles before the vaccine know that it was unstoppable. But then it was over and done with. You couldn't get the measles twice. I think that's why the cruise stocks held up well on a hideous day for the averages. Because, you know, that's a bet that you book them out a year, that the pandemic will, if it lasts, run its course. Now, before we get to next week's game plan, we need to talk about something very important. Last week at our CNBC Investment Club, the meeting, you know, that we had, well, boy, I've got to tell you, I have spent so much time thinking about how exciting that was. I do want you to join the club. It's really very, very cool. But I made the point in our club, it was our first conference. I made the point that it will get harder to pick stocks now that the Fed is tightening. I put that out there. See, in the words of the late, great Marty Zweig, a fabulous technician whom I miss very much, you don't fight the Fed. But you know what Marty didn't say, but a lot of people seem to interpret what I said as? He didn't say you need to sell everything when the Fed starts tightening. He told you to raise some cash. There'll be some pullbacks, and you need to be ready to buy your favorites into the weakness. He also didn't say how long a tightening cycle would last, because it always varies. Go back to 2018, when J. Powell carpet bombed the bulls with his inartful comments about how we needed to overshoot in order to tamp down inflation. Sell, 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 sell. So he was going to hit us with a series of lockstep rate hikes. Back then, Powell made you feel like we had one of those old-time Fed chiefs who were eager to burn down the economy in order to save it. The second coming of Paul Volcker, although at that point we actually needed it. Fast forward to this week, and we got a measured Fed chief that truly tried to discourage any kind of taper tantrum when the bonds and stock markets sell off hard after the central bank talks about cutting back its bond purchases. Powell managed to protect the bond market. Stocks, not so much. We've had some horrific selling in pretty much everything NASDAQ related, which is not what's supposed to happen, at least according to the Wall Street playbook. There should be some respite. Let's think of the consequences of the Fed planning its rate hikes here. You can have this scenario where Powell turns out not to be a man of his word, where he takes the 2018 approach and napalms the whole economy, at which point you've got a good 100% cash in your discretionary accounts, and even sell down your retirement accounts if you're older. That's drastic. It would certainly not be my choice. But if you're terrified of the Fed, I say raise some cash and get ready to buy lower. Don't walk away. However, I think that scenario is incredibly unlikely. Powell learned his lesson from 2018, where he had to immediately change course because the damage was so severe. More likely, we're going to get the second scenario, where he slows the economy to the point where the industrials and the retailers start missing the earnings estimates. So what do? Do you just leave the table? Just say, listen, I can't take it anymore? Everything's going down? No! In that environment, you buy the safety stocks. Eli Lilly. Hey, how about PepsiCo? Coca-Cola. McDonald's. I'm also thinking, by the way, that you can buy Costco on any hit. Costco. Because Costco does so well in this environment. Walmart, if it goes lower, that's a tougher one. I'll talk about that later in the show. Now, you can also pick up some United Health Group, which rarely comes in. Or you can decide that the Johnson & Johnson breakup is better than Wall Street seems to believe. That, by the way, was ridiculous. The rotation took it to 170, but when they actually announced the story, it went down. It's worth a lot. Or if you want dividend protection, and I don't blame you, and this stock was down today, how about on Monday buying some American Electric Power? Or how about going back to Enbridge when we spoke to Al Monaco earlier in the week? Pipeline play, 7% yield, growing yield. That one's good. Finally, you can do something really aggressive and begin to plan for the end of COVID as we know it. And I know that seems like it's almost impossible on the verge of what's going to be a miserable weekend, a winning weekend for COVID, not the human race. Well, you might want to bet that the tightening cycle won't last as long and will not be as hazardous as we think because people will go back to work. An extra soft landing. In this rosy scenario, you can buy our favorite tech stocks. Well, I'm going to throw a couple of them at you. I'll say Amazon, because we know that that's doing well because of Omicron. Marvell, they just reported. AMD, that Xilinx deal is going to close. You know what? I like the autos too here. Although I wish that Ford had been able to dump its stake in Rivian at a higher price. Now, all of these charitable trusts, these are charitable trust names. And if you want to learn more about them, then you should join the investing club. We have so much. There's the sell side, there's the buy side, and then that's your side. And that's what we're doing with the investing club. Next week is a holiday week, and we have to be ready for, let's say what I hope is the really bullish part of the Santa Claus rally. The one that Larry Williams, one of the best market historians ever, has nailed again and again. If you believe Williams, you'd have to buy the market, or more specifically, one of the three camps I just mentioned, on Tuesday. That would be your pull the trigger day. I think it's worth making that bet because the Santa Claus rally has happened virtually every year for over 2 decades, including much tougher times like December of 2008. Remember, that was when you had actual systemic risk. We do not have that. We've got sickness, definitely, but not systemic risk. I can't believe how big Monday is because we have not one but 2 stocks that are tremendous tells for the global economy. Not unlike Federal Express last night or Darden today. By the way, the Darden was, it got hit because of a management change. FedEx was actually a relief rally. A lot of people felt that FedEx was going to blow it. By the way, I do want to salute the amazing Gene Lee, who turned Darden around. He will be retiring, and that, more important than the Omicron strain, knocked down Darden. So what are these 2 tells? Well, let's see. After the close, we hear from Micron, the commodity semiconductor company. I think it's still a buy because the secular demand for its chips remains undiminished, even though people think it's cyclical. It's not secular. Then there's Nike, which is incredibly hard. Too hard for me. My gut says the China business will be good, and Nike pulls it off again. I actually like the American companies with big Chinese exposure here because they're coming down a lot. Although there's been some real negative publicity for the Starbucks and the People's Republic of late, Starbucks is very intriguing, and I'm not as concerned about the labor issues as many others. So it wouldn't shock me if Micron or Nike, or both came in better than expected. I wish I could be more specific, but they come down, and they are excellent bounce candidates. Tuesday, General Mills reports, and the street has decided that Mills, as it is called, is the right kind of stock to own here. Yes, it is the star of the Wall Street fashion show. It's got great franchises, including terrific stay-at-home cereals that you can eat all day, thanks to COVID. If you believe Jay Powell will destroy the economy in order to save it, and I don't, General Mills is your stock. At the close, we hear from BlackBerry. Now, this is a meme stock, and the meme stock guys are always trying to get this one roaring when it reports. They just go to town saying it's great and has all this intellectual property, so who the heck is Jim Cramer to disparage it? Well, you know who he is? I'm a guy who doesn't want to touch BlackBerry. That's who. Why? Because it continually disappoints. Finally, Wednesday is chock full of quality stocks. I like a couple of them here. CarMax, because of the used car shortage. Cintas, because it rents out uniforms for small and medium-sized businesses, as well as some larger ones. Paychex, which always reports a solid quarter and then sees its stock getting obliterated, giving you an amazing chance to buy it once again. It just doesn't stop. That's the way. And if you look at Paychex, we've been behind it, by the way, since 35. It's at 125. Every single time we've told you to buy, because we like Paychex. Okay, here's the bottom line. You need to recognize the rockiness of the moment. You need, let's say, you don't want to be heroic here. You've probably raised some cash already if you've been watching the show or if you're a member of the investing club and you've been listening to me at the club level. So it's time to put a small amount into action on the way down when everyone freaks out about Omicron when we come in on Monday morning. Zachary in New York. Zachary.
Hi, Jim. Thank you for all that you do. My question is regarding Block,
Thank you.
Formerly Square, and your stance on it as a long-term financial technology play. I've noticed that the share price is down roughly 25% year to date and about 30% in the last 6 months. Revenue growth appears steady year over year, nearly doubling the past few years. I've been buying some shares in the 160s recently, and I wondered if you thought that this current price is a good entry point and the stock's bottomed out, or if I should remain patient and you think it has further to fall. Thanks a lot.
Okay, let me give you what's really happening. Afterpay, okay, is a buy now, pay later company that they paid $29 billion. It's an Australian company. I think it's worth a fraction of that. I mean, literally, much. I'm talking about maybe $3 billion. Buy now, pay later is now starting to be talked about as being buy now, never pay. Thank you, Matt Horween, for giving me that one. And that's what's destroyed the stock, is they paid way too much. And I don't know how to get out of the fact that deal's done. So right now I'm a little on the sidelines here because they paid too much for an asset that's worth a fraction of what they should have paid. And that is really too bad. So I can't recommend it. Now I want to go to Jason in Florida. Jason.
Booyah, Jim. This is Jason and Max in Miami. Thanks for taking our call.
I'm thrilled that you called. Thank you.
We want to talk about NCLH today, okay? So we loved it in single digit. We like it in the early teens. And now just curious what you think with the latest variants.
Listen, I think that Norwegian, we're going to hear from Carnival next week. I think Norwegian's going to say, you know what? The order book is terrific. Yes, there's COVID, but there's COVID everywhere. You can cruise. I think Frank Del Rio's terrific, and I am announcing once again, I intend to cruise in 2022. All right, guys, don't be a hero. Things are very hard, but it's because of a public health issue, not because of earnings. Opportunities there. Oh, man, tonight, in this rough sea of red, I'm talking to the CEO of a company that closed in the green. Don't miss my exclusive with STEM. Then, you stumped me, Cramer. It made me sad, but I'm catching up on some homework. And I always tell you not to keep all of your eggs in one basket. And in this market, that's more important than ever. Thank you, Omicron. That's why we're playing MI, diversifying. So stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.